Finally, we will use our free cash flow models to perform the valuation. First, we will use our free cash flow to the firm model to derive an estimate of the value of the entire firm. This section of the worksheet contains our free cash flow to the firm model. We discussed this model previously. We have our free cash flows to the firm. We now need to discount them back to arrive at a value for the entire firm or enterprise. We perform the valuation in two parts. We discount back the free cash flows to the firm over the volatile horizon period. We then calculate the continuing or terminal value for the firm at the end of the forecast period, once the company has reached stable growth. We do this using a perpetuity formula. We then have to discount the continuing value back to the valuation date at the beginning of the forecast period. We add up the discounted cash flows to arrive at an estimate of the value of the entire firm. Because our data is denominated in thousands of pounds, we multiply the estimate by 1,000 to get it in pounds. The final value will be the enterprise or firm value for the entire firm. Let's carry out the valuation. We begin by inserting our forecasts for free cash flow to the firm. We then have to insert the appropriate discount rate, which for free cash flow to the firm is the weighted average cost of capital, or the WACC of the company. The formula to discount the free cash flows to the firm is already inserted into each of these cells. This row represents the discounted free cash flows to the firm. We also need to insert a growth rate for the perpetuity formula. I'm going to use the assumed growth rate in sales revenue at the end of the forecast period. This cell contains a perpetuity formula which calculates the continuing value or the terminal value for the firm based on these inputs in the base year. We then discount back this continuing value to the beginning of the forecast period. Finally, we add up the discounted cash flows to arrive at the enterprise or firm value. This is denominated in thousands of pounds, so we multiply it by 1,000 to get it in pounds. We can see our fictional grocery retailer has an enterprise or firm value of 421 billion pounds. Next, we will use our free cash flow to equity model to value the firm's equity. This section of the worksheet contains our free cash flow to equity model. We've discussed this model previously. We will discount back our estimates of the free cash flows to equity by the firm's cost of equity to arrive at an estimate of the value of the firm's equity. Again, we perform the valuation in two parts. We discount the free cash flows to equity over the volatile forecast period. We then use a perpetuity to calculate the continuing value of the firm at the end of the forecast period, once the firm has reached stable growth. We then discount back the continuing value to the valuation date at the beginning of the forecast period. And finally, we add up the discounted cash flows to arrive at an estimate of the value of the company's equity. Since the data is denominated in thousands of pounds, this estimate will be in thousands of pounds. If we multiply the estimate by 1,000, we get an estimate of the value of equity in pounds. If we divide that estimate by the number of shares the firm has outstanding at the valuation date, That will give us an estimate of the price per share per our valuation model. We can then compare this with the current market price of the firm. Let's perform the valuation. I'll begin by inserting our estimates of the free cash flows to equity. Next, I will insert an appropriate discount rate, which is the cost of equity for this model. Finally, I will insert a stable growth rate for the perpetuity formula. Again, I will use the growth rate in sales at the end of the forecast period, which we estimated at 2.8%. We can see the discounted cash flows over the volatile forecast period in this row. We can see the undiscounted continuing value for the company in this cell. This cell contains the perpetuity formula. If we discount back the continuing value to the valuation date, we arrive at the discounted figure in this cell. Finally, if we add up all of the discounted cash flows, we arrive at the estimate for the value of the firm's equity in thousands of pounds. If we multiply this by 1,000, we get our estimate of value in pounds. If we divide that by the number of shares outstanding at the valuation date, we arrive at our estimate of the price per share per this valuation model, which comes out at £1.24. We can then compare our estimate of the value per share to the current market price of £1.88 per share. We can see that based on our valuation and the assumptions that we've made about the outcome of Tesscow's restructuring exercise, that there is a potential downside of %34 with this stock. If you were confident about your valuation, you would make a sell recommendation for this stock. Now is the time for a few caveats. Number 1, valuation is a subjective exercise. It is based on your beliefs and assumptions about the future. It is an art, not a science. If you enter any series of numbers into a valuation model, some value will pop out at the other end. What is important is that you've thought carefully about the assumptions that you've made, and particularly about the forecast ratios. Make sure they are reasonable and you can justify them if challenged. You must be able to stand over them and argue in support of them. This is also why good model design is important. For example, if you've used dynamic formula and avoided hard-coding any cells when constructing your model, you can quickly and easily alter your assumptions and see the impact on your valuation. This is useful to run through alternative scenarios and future outcomes. It is an important part of sensitivity analysis. For example, with Tesscow, if we revised our estimates of the growth rate in sales revenue over the forecast period, for example, we felt the growth rate, rather than being 1.6% over the first 5 years of the forecast period, needed to be revised downwards to 0.5%. Because we've used dynamic formula throughout the model and avoided hard-coding any cells, we can immediately see the impact of these revised assumptions on our estimate of the share price. We can see it's gone from £1.24 down to £1.20. We can also see the potential downside has gone from 34% to 36%. The next important caveat is more of a disclaimer. This series of presentations is intended to give a basic overview of the free cash flow valuation process. I've used real data for a fictional firm to simulate a real-life valuation exercise. The idea is, once you know the basics, you'll be in a better position to learn about the different parts of the process in more detail. With that in mind, I'd like to point out some obvious issues with the valuation model that we've built for Tesscow. Firstly, we didn't bother to forecast many of the line items in the financial statements. When you do this, in effect the balances in those accounts fall into the plug in the first year of the forecast period. This results in bizarre figures in year 1. We can see the effects of this on our estimates of free cash flow in year 1 of the forecast period. Secondly, we used a very simple plug to forecast the balance sheet. We used net debt, which is defined as cash less debt. This was problematic when it came to calculating the change in debt component of free cash flow to equity. It resulted in some bizarre figures. A more sophisticated plug that separates cash and debt would be advisable. Finally, we've used a simple growth perpetuity to calculate the continuing value for the company. There are more appropriate perpetuity formula available. We will discuss these in more detail at a later stage. To summarize, the point of this series of presentations is to teach you the basics of free cash flow valuation. If you wish to learn about the different parts in more detail, I would recommend a book titled Valuation by McKinsey & Company. I'll put a link for the book in the description. The book goes chapter by chapter through each stage of the process in detail.